Hi, I'm Ray Meadows, Prince of Finance, and with me is my friend Hiromi. And I got a question. Have you ever actually put in an order for a stock or ETF? You know, at your broker, you have a brokerage account, right?
Yes.
Have you ever put in an order to buy something?
By myself?
Yes.
No.
No.
Because I'm scared.
Oh, okay. Do you know what is a limit order or market order?
No.
No. Okay. So let me just cover those real quickly.
Yes, please.
Okay. If you put in a market order, you are saying, I'm going to buy the shares at whatever price is available in the market right now when I put my order in. Okay. And to determine that, you have to look in the market. There's always someone in there with a bid and an ask. The bid means they're willing to buy at that price. And the ask means they're willing to sell at that price. So for example, maybe someone is bid. So we talked about a particular ETF whose ticker is MINT, Mint. It's actually like a money market ETF. And so the bid might be $101.10, for example. And the ask might be $101.11. Okay, so only 1 penny apart. So if you're wanting to buy, you're going to get the ask. 101.11. But if you want to sell, you're going to get 101.10. Now, that particular ETF, the bid ask is 1 penny, very small. But there could be cases where the bid ask is much larger. It might be the bid is 101 and the ask is 102. So, you know, there's a whole $1 difference between bid and ask. That could happen. So how do those bids and asks get there? So it's what the other type of order is called a limit order. If you want to set a bid and an ask, you put in a limit order. You're saying, I'm willing to buy at 101 and no higher. That's a bid. Limit order. And if you want to sell, you could say, I'm willing to sell at 102 and no lower. So if you put those in on a stock and no one was willing to buy or sell lower than you, you would have the bid ask. And every time someone bought on this side and sold on this side, you'd make the spread. Every time you did that trade. So there's companies out there that do nothing but offer to buy and sell stocks, and they make the bid ask spread over and over and over all day long. And that's how they make money.
A penny.
They make a penny.
The penny keeps moving.
Yeah, penny keeps moving, right. But some of us don't want to give up that extra penny. And so we're only...
Out low.
Yeah. That's why when I helped you put in that order, I said, we're going to only
And it didn't
buy...
go through.
And it didn't go through because no one was willing to sell us at
And
that.
I didn't know how to take care of it.
And I told you the next day, raise your limit order by a penny. Because I knew that sooner or later someone was going to sell to you. Because they're going to be more anxious than you. And if you're more patient, you get a better price. So I said, use a limit order. Because you want to get the bid-ask spread, not let them have it. That's the idea. Now, in the case of Mint, the bid-ask spread's only a penny, so who cares?
I care.
Okay, well, you care, I care, but some people don't care. But that's because the reason why it's only a penny, that's called liquidity. It's a very liquid stock, meaning there's a lot of buyers and there are a lot of sellers and you can trade a lot and it doesn't impact the price. But there are stocks or ETFs with lower liquidity, meaning not as many people want to trade them. And if there's not as many people trading them, then as I said before, the difference between the bid and the ask can be pretty big. So in that case, you don't want to just go, oh, whatever, I'll take whatever price you want. You want to put a limit order in and get a better price. Let's say something that you like, it's some small little stock, and it's trading at 101 is the bid and 102 is the ask. And let's say you want to buy it. Well, you don't really want to pay 102 because then, the next day if you want to sell it, it's already $1 down. So you're okay, I'm going to outbid the 101 guy, but I don't want to pay the whole 102. So you can put in a limit order in at 101.50. And now if the guy who wants to sell goes, oh, well, it's better than 101, so he might sell it to you. The next one, and the guy that's 101 doesn't get the deal because you got it. So you can use a limit order. Now, the other thing about using limit orders, any stock that doesn't trade much, you should always use a limit order because you never know what's going to happen. Even some stocks that do trade a lot. Did you ever hear about this thing called the flash crash?
No.
Okay. A couple years ago, something went crazy in the market and a bunch of stocks went down like 30% in 10 minutes.
Whoa.
Okay? If you happen to have a market order in on the wrong side of that market, you would have lost a lot of money.
Ah.
And then it went right back up 10 minutes later. And you would have went, how did I lose 30%? Because you used the market order. So sometimes, limit orders are safer than market orders. The only catch is, as you learned, you don't always get your trade.
Right.
Sometimes they won't move it. But if you sit there and watch it, you can just move it up until you get your trade. So anyway.
Patience.
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 But anyway, it's good to know the bid-ask spread because you're saying, how much am I going to pay versus what would someone sell it to me for? What's the cost of trading? This is actually the cost of trading, if you think about it. Because if you buy it one day and sell it the next, you're going to pay the difference between these two to do that round-trip trade. So the wider that is, the more it costs to trade a stock, and the less liquid it is. So that's bid-ask spread. And limit order and market order. So how are you gonna put your order in?
Limit.
All right.
Order.
Okay.
There you go.
All right. Bye.